Right now, one of the most popular AI stocks on your watch list may be hiding a tax you have never seen on any statement. Oracle just proved it, its worst single month in over 3 decades, down 35%. $100,000 in Oracle became $65,000 before the month was out. That is not a paper loss. That is a year of car payments gone in 30 days. The real question is not what happened. It is whether the data warned us first. There is a hidden cost built into stocks where the price races far ahead of the business. Call it the AI hype tax. The premium you silently pay for a story, not for earnings. It never shows up on your brokerage statement. It hides inside valuation ratios. When sentiment reverses, the AI hype tax gets collected all at once, very fast. Oracle is a near-perfect case study for learning to spot it before the bill arrives. Oracle sells enterprise software, databases, and cloud infrastructure to large corporations. It is a real, profitable business with decades of revenue, not a startup burning cash. Starting around 2023, Oracle rebranded itself aggressively as an AI infrastructure play. That rebranding helped the stock roughly double between early 2023 and early 2025. The business grew, but the price grew much faster, and that gap is exactly where the AI hype tax lives. The first tool in our checklist is the price-to-sales ratio, or PPS. PPS tells you how many dollars the market pays for every $1 of annual revenue. A PS of 2 means the market values the company at twice its yearly sales, reasonable for mature firms. Before the crash, Oracle's PCS ratio had climbed to roughly 9 times sales. Oracle's own multi-year average PPS had historically sat closer to 4, so it was trading at more than double its norm. That gap between current and historical PS is a flashing amber light on the AI hype tax dashboard. A high PS can be justified if revenue is growing explosively, so growth rate matters enormously. Oracle's revenue growth was running in the high single digits annually, solid, but nowhere near explosive. High single-digit growth cannot justify a PS of 9. The math simply does not work out. This mismatch between growth rate and valuation multiple is the first red flag in our checklist. The second tool is free cash flow yield, the real cash a business generates relative to its price. Free cash flow yield equals free cash flow divided by market capitalization expressed as a percentage. Think of it like the rental yield on a house. How much cash does owning it actually return each year? A healthy large-cap stock typically offers a free cash flow yield somewhere in the 4 to 6% range. Before its crash, Oracle's free cash flow yield had compressed to roughly 1 to 2%. At that level, you are paying a very high price for every dollar of real cash the business produces. Here is where the AI hype tax gets more expensive. Because alternatives exist. A 10-year US Treasury bond was yielding around 4 to 5% at the same time. So you were taking full equity risk for a yield far below what a risk-free government bond offered. That gap represents the AI hype tax as an opportunity cost, money not earned every single year you hold. Comparing FCF yield to the risk-free rate is the second red flag in our checklist. Third tool, earnings quality, asking whether reported profits are backed by actual cash. Companies can report strong earnings using accounting choices that inflate the number without matching cash. One simple quality check, divide operating cash flow by net income. The ratio should sit above 1. Below 1 means the company is reporting more profit than it is actually collecting in cash. Oracle's ratio was near or below 1 during its peak valuation period, a quality warning sign. Low earnings quality means the AI hype tax may be even larger than the headline numbers suggest. Oracle also carried a heavy debt load, tens of billions of dollars at its peak valuation. High debt amplifies the AI hype tax because rising interest rates make that debt more expensive to service. The interest coverage ratio measures how many times operating income covers annual interest payments. Below 3 times is generally considered a caution zone for large established companies. Combining heavy debt with a compressed FCF yield is the third red flag in our checklist. Numbers alone do not cause crashes. Sentiment is the trigger that turns overvaluation into a collapse. When investors believe an AI story, they bid up multiples far beyond what fundamentals support. That narrative premium is the core engine of the AI hype tax. Pure expectation, zero guarantee. One disappointing earnings report or guidance cut is enough to pop the balloon instantly. Oracle's June 2025 catalyst was weaker than expected cloud growth guidance. One number, massive consequence. A 35% drop is not just painful. The recovery math makes it especially brutal. To recover from a 35% loss, you need roughly a 54% gain just to break even. That asymmetry, losses requiring proportionally larger gains to recover, is called volatility drag. Assuming a 10% annual gain, recovering from 35% takes roughly 4 to 5 years. Volatility drag is one reason avoiding the AI hype tax matters more than chasing the upside. Let us pause and build the checklist. 4 quantitative questions you can ask about any stock. 1. Is the PS ratio more than double the company's own long-run average? 2. Is the free cash flow yield lower than the current risk-free rate? 3. Is the operating cash to net income ratio below 1? 4. Does the company carry heavy debt relative to its interest coverage capacity? 3 or 4 boxes checked means the AI hype tax on that stock is likely very high. Now run Oracle through all 4 questions using its pre-crash numbers. PCS near 9 versus a long-run average closer to 4, more than double, red flag checked. FCF yield compressed well below the risk-free treasury rate, red flag checked. Earnings quality ratio near 1, borderline, amber flag, not clean. Heavy debt load with rising interest costs, red flag checked. 3 red flags and 1 amber. The checklist was flashing loudly before the crash arrived. To calibrate the checklist, compare Oracle to a hypothetical lower AI hype tax peer at the same time. A stock trading at 4 times sales with a 5% FCF yield scores 0 red flags. The contrast shows the checklist is not about industry, it is about price paid versus value received. Boring valuations rarely make headlines, but they also rarely produce 35% single-month drops. Here is a caveat. Many Wall Street analysts carried buy ratings on Oracle heading into the crash. Analyst consensus is a lagging indicator. It reflects yesterday's story, not tomorrow's risk. Quantitative metrics are more current. They measure today's price against today's fundamentals. The AI hype tax does not care what analysts say, it only cares about math and gravity. Does this checklist actually work historically, or is it just hindsight? Academic research on valuation factors consistently shows high PES stocks underperform low PES stocks over multi-year horizons. Research by Aisnes and colleagues has found that expensive stocks, across multiple measures, tend to mean revert toward fair value. The timing of that reversion is unpredictable. Overvalued stocks can stay expensive for years before snapping. This is why the checklist is a risk signal, not a short sell signal, a very important distinction. Even if you love a company's story, position sizing is how you manage the AI hype tax in practice. A 5% position losing 35% costs your total portfolio about 1.75%. A 25% position losing 35% costs your total portfolio about 8.75%. Same crash, very different outcome. That gap is the math case for diversification. The AI hype tax is most dangerous when concentration amplifies it across your whole portfolio. A second diversification problem, AI-themed stocks tend to move together, raising portfolio correlation. High correlation means owning 5 AI stocks is not the same as owning 5 independent bets. When Oracle fell, other cloud and AI infrastructure names sold off at the same time, correlation in action. The AI hype tax spreads across correlated holdings, multiplying the damage beyond a single name. Adding assets with low correlation to AI stocks is one structural way to reduce this cluster risk. A fifth optional tool is the PEG ratio. Price to earnings divided by the earnings growth rate. A peg below 1 suggests the market may not be overpricing growth. Above 2 is a caution zone. Oracle's peg was running well above 2 before the crash, confirming the AI hype tax was elevated. Use the peg as a cross-check. It should agree with your PBS and FCF findings. Not all revenue growth is equal. Recurring subscription revenue is more durable than one-time project revenue. Oracle's cloud revenue was growing, but a portion came from large multi-year contracts booked up front. Upfront contract bookings can flatter near-term growth without reflecting sustainable ongoing demand. Checking deferred revenue trends on the balance sheet reveals whether today's growth is borrowed from tomorrow. This deferred revenue check is an optional 6th item you can add to your AI hype tax checklist. Insider transactions are public data. A pattern of executive stock sales near a peak is a soft signal worth noting. Insiders sell for many reasons, so a single sale means little. But repeated sales at peak valuations are notable. Oracle insiders filed notable sales in late 2024 and early 2025, near the stock's peak price. Insider selling does not predict a crash, but it adds one more data point to the AI hype tax picture. Every framework has failure modes. Let us be honest about when this checklist gives false positives. Amazon traded at extreme PS multiples for years while the business was fundamentally transforming its economics. When a company is genuinely restructuring its economics, historical averages are the wrong benchmark. The checklist works best for mature companies using AI as a marketing overlay, not genuine platform transformations. Apply it with judgment, not mechanically. It is a risk thermometer, not a fortune teller. Here is where the AI hype tax gets more expensive over time. It compounds against you. Overpay significantly at purchase, and you need proportionally more return just to match a fair-priced buyer. Over a decade, that starting disadvantage compounds into a substantial gap in final wealth. The AI hype tax paid at purchase is costly precisely because the compounding headwind never stops. A cleaner way to think about valuation risk is expected value, probability multiplied by outcome. If a stock has a meaningful probability of a large drawdown, that expected loss must be weighed against the upside. At 9 times sales with modest growth, the expected upside was limited while the downside tail was large. High AI hype tax stocks tend to have negative expected value skew, small upside, large downside tail. That negative skew is the mathematical reason to reduce exposure, not fear, not gut feeling. Large quantitative funds systematically screen for exactly these metrics across thousands of stocks simultaneously. They assign factor scores to each stock, value, quality, momentum, and risk. Pre-crash Oracle would have scored poorly on value and quality while scoring well on momentum. When momentum reverses, a stock with poor value and quality scores has nothing to catch its fall. Individual investors can replicate this logic manually using free data from financial websites. All checklist metrics are available for free on sites like Macrotrends, Stock Analysis, or similar financial data sites. For PTS history, search the company name plus PTS ratio on Macrotrends. The chart loads in seconds. For FCF yield, divide trailing 12-month free cash flow by current market cap, both on the summary page. For earnings quality, find operating cash flow and net income on the cash flow statement. 1 page, 2 lines. The whole checklist takes under 10 minutes per stock. Less time than reading a single analyst report. Here is the AI hype tax checklist in final form. 5 questions, each answered yes or no. 1. PS, more than double long-run average. 2. FCF yield below the risk-free rate. 3. Earnings quality ratio below 1. 4. Debt coverage in the caution zone. 5. PEG ratio above 2. Score 1 point for each yes. 0 to 1, low AI hype tax. 2 to 3, moderate, consider sizing down. 4 to 5, high, review carefully. Oracle scored 4 out of 5 before its crash. The checklist was doing its job. Important, this checklist does not tell you when to sell or whether to sell at all. It measures the AI hype tax embedded in a current price. What you do with that is your decision. Tax laws, account types, personal goals, and time horizon all affect whether reducing exposure makes sense. A financial advisor who understands your full picture is the right person to discuss specific actions with. Oracle will not be the last company to carry a high AI hype tax. The cycle repeats with every technology wave. The dot-com era saw PS ratios of 20, 30, even 50 times sales before collapsing. Every time, the same pattern, narrative premium builds, fundamentals lag, sentiment reverses, AI hype tax collected. The checklist does not stop the cycle. It helps you know how much AI hype tax you are currently holding. Knowing how much you are holding is the first step toward deciding if the story is worth the price. Download the free AI hype tax checklist template linked below. 5 questions, 1 spreadsheet, under 10 minutes per stock. Subscribe for more quantitative frameworks every week. This video is for educational purposes only and does not constitute financial advice. Past performance does not guarantee future results. Always consult a qualified financial advisor before making investment decisions.